and welcome to Big Deal. I'm Nisha Poddar, and as you know, we have a special guest today in our studios. The CEO of KKR India, Mr. Sanjay Nayar, is right here with us in the studio. Mr. Nayar, good to have you on the show. Now, your fund has really been the best performer when it comes to the exits that it has seen. We've seen two large transactions back-to-back, Gland, Pharma, as well as Tyre. So it gives a lot of hope to the entire private equity industry, really, when it comes to the returns and the kind of exits they can make from their investments into the country. Does it make you more confident about India investments?
Well, I think firstly it does make all of us very confident. There's no doubt about that. I think in terms of the exits, there have been quite a few. They're not all done as yet and dusted, but I think what we clearly are seeing is a very clear path to realizing returns in India and sending money back to investors. And I think that's just conceptually a huge sign of confidence, which will hopefully bring in a lot more money into the country. But yes, overall, you're right. I mean, there is an increasing sense of confidence with a pickup in capital markets, interest by strategics. So yeah, there's a lot more activity in our industry.
Okay, so looking at this kind of a performance, does it also make you more confident about more investments coming in? How much have you deployed, and what is the strategy going forward for KKR in India?
So we have a large private equity fund, which is a regional fund. We are currently investing out of our Asia 2 fund, which is a $6 billion fund. We have two large NBFCs in India. Both are capitalized around $250 million each. One addresses mezzanine corporate solutions. The other one addresses mezzanine real estate solutions. And the third business we have is a special situation business, which is investing out of a global special situation fund and does deals that are a lot more, I would say, stressed, not distressed. And finally, we're looking at, obviously, creating an ARC in due course. So, you know, when you put all this together, I think we have the answers. We just need to make sure that we can try to find the right answers for our clients and then try to find the real solution. So that's our overall strategy. I don't think it's driven by how much to deploy, who to do business with. And then, of course, we've got to have an overall approach of what themes and what sectors.
So looking at your entire structure of KKR in India, it looks more like a bank than a private equity fund.
No, actually, it's not a bank. I mean, the deals we do, banks cannot do. So this is actually
better than a bank.
These are all no, I don't. Well, that's different. Look where the banks are trading, and you know, it'll make you all of you feel poor. Okay, so let's not compare to the banks. The banks are just on a complete roll right now.
Yes.
I think we try to do deals which are by definition non-bankable. If the banks could do these deals, I don't think we have the cost of capital which can match the banks. So no, we don't want to look like a bank. We're not a bank. We're actually a alternative pool of capital, which I think has finally found its place between private equity and venture capital, the right phase now in India, where India growth is picking up. And I think this capital can play a very, very critical role. And
I'll also say that you are also an iBanker at heart. I see that whichever company you enter, there is a deal struck there.
I don't know. I mean, I don't. Well, firstly, I'm not an iBanker right now. What we try to do, I think, a little bit more is that we try to think with the promoters strategically. Okay, how can we help you grow? How can we help you maybe deconsolidate? How can we help you go global? And these force will have M&A as an integral part of the discussion. So it's not like we just go there and do a deal. It's like you've got to have a thesis. How will you grow? And you look at the case of our cement investment. You know, for 3-4 years with Puneet's a fantastic entrepreneur, and he had the risk appetite. We had the risk capital. And together, you know, we went and built a platform together from 10 million tons to 24 million tons. And 3/4 of that was M&A. So I think that's the approach. It's not because, you know, we just want to do a deal for the sake of it.
No, not the heck of it. But of course, Dalmia has seen, and in fact, Avanta Group and most of the other investments, Max is in the middle of an M&A. So yes, most of the companies that you have been invested in, there has been either a deal or a value unlocking as well, like we've seen in CCD as well. What has been your investment theme for the country? Which are the sectors which you prefer? Because most of the private equity players have really restricted themselves to the age old safe havens, which are generally financial services or else consumption-based or pharma, to be, a few of them.
The last two investments of ours, which is in the tire sector and in the pharmaceutical sector, both these are actually built by two fantastic entrepreneurs. We just helped them go to the next level. So I think we liked this bespoke manufacturing value add where India's cost competitiveness and I would say design smartness, R&D smartness comes in, and it caters to the global markets. And right now, I don't think we are looking at everything that is fashionable. I mean, today NBFCs are fashionable and so is pharma and IT. I think we are getting away from all of that and saying, where can we value add? And our sense is we want significant majority stakes, whether it's public sector companies or private sector, and see if we can really operationally do better than what the previous management was doing. So our focus is shifting more towards operational value add, larger deals, not just thematic play, something is cheap, let's just go and buy 5%. I think we're just getting away from that.
All right. And any particular bright spots that you are focusing on? Of course, manufacturing is...
It's still going to continue. I think manufacturing is still looking exciting. And plus with operational ease in India now, given the government's concerted focus that we are actually seeing now translate into operational ease, I think manufacturing has to remain a top priority for us. Also, we are finding that, credit is becoming available. Labor is still tough, but some of the ingredients that go into manufacturing is looking quite interesting. I think we are looking at financial services, but we prefer to build platforms. We like media, we like financial services. That's, I would say, the rest of it is more to do with a deal per se. If we find a deal that is a buyout opportunity or a significant majority or a big conglomerate is demerging certain units and divisions, and that, by the way, is increasing in the country, I think then we're going to get very, very focused on that.
After your Crompton deal, of course, a lot of, consumer electric businesses are trying to demerge, value unlock from their existing parent companies and look at selling prospects. So in a way, that particular deal was a yardstick, a benchmark for the rest of the industry in terms of valuations. Yeah,
but just for clarity, we didn't do the consumer deal. We actually were a lender to the conglomerate. And the conglomerate then demerged and sold consumer to Advent, and we made whatever returns we made in our loan that we had given. But yes, I think it goes to show that well-meaning entrepreneurs now are challenging themselves and saying, why do I need to have 6 different businesses? Am I better off demerging? And you're seeing a spate of demergers now. I mean, they're just happening on their own. It's not driven by private equity necessarily, but I think Indian entrepreneurs are now saying, I want to be more efficient about the use of my capital. Okay, and for the first time, we're finding them say, what's my return on economic capital? What's my return to shareholders? What's total shareholder return? And these questions are throwing up very obvious answers, which is, why do you have a clutter of businesses? Why do you have holdcos with so many opcos? There's a lot of rationalization going on, and I think that will throw up a lot of opportunities. But
Sanjay, also demergers are happening and value unlocking, and then therefore there will be a sale that is in the mind of the promoters for these scheme of arrangements that we always see. But there is also valuation expectation, which is on the higher side. Do you think the valuations are running ahead of their fundamentals, and especially with the way equity markets are right now?
See, at a very top level, I mean, one can have a long chat about this, but at a very top level, when you have, a risk-free rate where it is today, and you look at net income growth of between 8 and 10%, obviously the obvious answer is that the markets are overvalued, trading at 18 times earnings. But I think you have to be a lot more specific about the stocks and sectors. I think some sectors are pretty expensive. I don't think anything is obviously cheap. So you really have to go and find those situations to make the investment. But things are discounting a lot of good things in the future. They are clearly discounting macro stability, which I think is a given. I think they are discounting a pickup in investment spending and savings increase, which is not happening in a hurry. And I think they're also discounting a pickup in consumption and pricing power, which looks a little bit more distant than we thought. And the reason is that there is still a degree of inflation expectations in the consumer's mind, and I think that's holding back people a little bit. But look, I think we're on the right path. I mean, the amount of work that is going on, and we can talk about it, maybe the government spending has kick-started everything, so that's maybe a separate discussion. But I think things will pick up. But it's not going to happen in a hurry, and to your point of the markets, I think the markets are discounting a lot of that today.